All right, as mentioned just before I started this webinar, this is going to be recorded. One thing I mentioned at the beginning of all these is watch it again relatively soon afterwards because some of the nuances may sink in. Yes, this is just a short put spread. Anybody can teach you how to do a short put spread, but I'm going to go into some details and rules that will help you increase your probabilities of success. And that's really important, you guys, because most people out there will just kind of give you a kind of blanket statement, you put on a short put spread, well, whatever, but they don't give you strikes and rules around the environment in which you are implementing this strategy. And I have some very strict rules in a sense where you need to go down the checklist and make sure they're all checked off before you implement this strategy. It doesn't always work out, and in that case, move on to either a different strategy if you are really bullish in that underlying, or move on to a different underlying where you can implement this strategy. So, and you might wonder, why would you just do that? Well, anytime your portfolio gets out of whack, whether it's too many deltas, which my portfolio has a tendency to get, this is a great way to add long deltas into that portfolio. And deltas being negative means you're bearish in your overall portfolio, and long deltas means you're overall bullish in that portfolio. So this is a great way to make some adjustments to that said portfolio. Okay. Assignment is the biggest issue. Yes, it is, but you are long a put as well on this defined risk strategy, so you don't really have to worry about that as much. And I'm going to explain why I don't really worry about assignment risk in this particular strategy for several reasons. One, if I'm directionally right and it goes through my strategy in a sense, then you always have that put. But the other thing is, we're not going to be in this very long to have to worry about that. So I like to cover these strategies rather soon anyway. So, but assignment risk would be an issue if it went through your spread. So yes, you do have to kind of worry about that. All right. So anyway, let me go over a couple of things real quick before I get on to some of the questions and everything else. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. Started trading in college with some money I had earned basically in high school and middle school for that matter. Been working real jobs since I've basically been 13 years old and worked on our family farm well before that. But so all that money, I put that money into a bank account and started investing with a discount brokerage. And then I started selling calls against some of those positions that I had in that portfolio. And that's how I got into options. So halfway through college, or not even really halfway through, about a semester and a half through college, I decided to switch my major over to finance from psychology. And after graduating, moved right up to Chicago and started working at the Board of Trade. I literally walked on the floor and started handing out my resume. Got a job as one of those runners down there, like in the back here, this picture, one of these guys just kind of running around, and made myself, sold out my stocks and jumped into the pits and started trading. So in that time, I've traded everything from stocks, financial futures, commodities, currencies, and options on all of those products. So I've seen a lot of things going on, and I've been in just about every type of trading environment, if you will. This basically says any opinions, news, research, and analysis, or other information does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why was we don't know your risk parameters, or I don't know your risk parameters. I don't know what's in your portfolios. So what I could be talking about could be counterintuitive to what you're already doing in your portfolio. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. One other thing, you can follow me on Twitter at Wolfman's blog for some trading snark and things of that nature. And you can follow us at ProTrader Strat on Twitter. Anyway, The bull's put spread, and this is a favorite. The reason why is puts usually have a lot more premium in them, which allows you to get further away from the market. This is a bullish spread because we're going to be selling that short put nearer to the money than the one that defines that risk, in a sense, where we're going to be selling the one nearer to the money and then buying one further out to define that risk. And the beauty in this is if you're directionally right, you make money, and even if the market just kind of trades sideways, it might even be able to go down a few dollars and you can still make money. Whereas if you were bullish and you did a long call spread, you have to be directionally right in order to make money, because that theta decay really eats away at you. And the other fact of the matter is you wouldn't want to implement a long call strategy in the type of environment you would have for this bull put spread. So there's different environments to make these strategies work the best. And this particular one, we want high volatility, and I'll go into that in a little bit more detail here in a minute. One thing with the bull put spread is we're always going to receive a premium. Now, we want to receive a certain amount of premium in order to take on this risk. If we're going to be taking on this risk, you guys, you need to make sure that the premium is aligned with that, so that you don't get messed up with collecting too little of a premium. We're going to take advantage of theta decay in this and volatility. We want it to contract. And the reason why I like to implement this around high volatile markets is volatility is usually overstated. It's kind of a fear index, if you will, and you guys, it will be overstated, probably over 75. I want to say 90% of the time, but I don't have exact stats on it, so don't quote me on those statistics. But volatility is overstated, as any fear is overstated. I don't care if you're afraid of spiders or something like that. That's an overstated fear in a sense. All right, so the essentials to success here: picking the right strike. The right strike here is when we're building this strategy out, we're going to be looking to start selling the short put at the 35 delta, somewhere right around there, which gives us an equivalent of about a 65% probability of success, or of that strike being out of money. One thing to realize, though, it has about a 70% probability of being tested. So we will be tested on this strike, and that is a high likelihood. But it being a defined risk strategy, we know what our risk and our reward is going into it. So you can hold solace in that. But just keep in mind that the probability of being tested on this, and making you feel like you're wrong, is about twice as much as the probability of it being right at the end of the day. So keep that in mind. 35% probability of, 35% delta equals a 65% probability of it being out of the money at expiration, and you have about a 70% probability of the market coming down and testing that short put. All right, so picking the right duration. We talked about this. We are trying to take advantage of theta decay in here. So we want to take advantage of theta decay the best way possible. The best way possible is, this is a basic chart. It's not always this perfect slope. Sometimes volatility will hold up this slope and flatten it out a little bit, which is kind of what we want heading into this, is to have that volatility kind of expand and hold up this theta decay. And then when that volatility comes out, we see a real fast, it's almost like the air coming out of the balloon when volatility comes out at theta decay, and that shrinks down. So we want to take advantage of it. We're right there in that wheelhouse with 35 days to expiration for the August. So that's set up perfectly. And as you can see, this is the calls and puts premium in a sense, and about 50% of that's going to take place right in this slope. So it's a perfect time to take advantage of selling premium anytime you're inside of 45 days is what I really like to set them up at. and then 35 days is still really good. But keep in mind, we're not going to hold it for this whole time, and if we have volatility in there, volatility comes out, we'll be able to get out in a matter of a couple of days sometimes. So we're going to try and play that if at all possible. Picking the right environment, I've mentioned this a few times, it's high volatility. We want high volatility and that vega contraction. You wouldn't really want to put this strategy on with like 60 some odd days to go, because it just takes way too long. If we're way out here in 60 some days, you can see you're not going to get that much decay going on. So we want to stay inside of 45 days to 35 days. And I want to be out well before this 7 days thing. So you do get a lot of contraction going on in there, but there's gamma risk and other things associated with that. You know, the little games in the markets where people are trying to pin their price and stuff like that to get their option settlement. I don't like to play around with it when they start moving that stuff around. I mean, picking the right underlying, you guys, this is really important, especially for newer option traders. Picking the right underlying really means that there's a lot of open interest and volume going on in these options contracts that we're trading. If you're trading something like AutoZone or something like that, where everybody's heard of AutoZone, but just nobody goes in there and trades those options. And like Aon, everybody's heard of Aon, but you know, a lot of stock gets traded on a daily basis in Aon, but at the end of the day, there's nobody in there playing in the options, and that bid ask gets really wide. So one of my rules of thumb with this is that we're going to be picking a stock that has a bid offer in the option montage right here, usually right around 35 days is the best way to judge it. And this goes for any option strategy. Start looking at those 35 days or something like that, or the near expiration cycles. And if that bid ask is inside of 10 cents on either the calls or the puts, somewhere close to the at the monies, that's the stock we want to be in, because that means there's a lot of participation in there, and it makes it easier for us to get in and out. If you have a bid ask that's like 25 cents wide on like a $30 stock, you're going to get eaten up on your yield getting in and getting out, because you have to give it so much edge to get in and have somebody come off the porch to trade with you, and then you're going to have that same problem getting out. And if volatility were so to happen to expand, or anything in the market starts getting crazy, people are going to leave that stock and go into like the Apples and the Teslas and stuff like that, where there's a lot more participation. So it's going to even be harder to get in and out of those. So if you're a newer trader, go into the ones where there's a tight bid ask right away, and then you don't have to figure out what the values of those options really are, because the market has determined that. And another thing is some stocks over $100, you know, if it's a $300 stock, anything over $100, I basically say move the decimal points 3 ticks to the left. So on a $300 stock, you move it 3 ticks to the left, the bid ask should be about 30 cents. All right, and knowing our exit strategy before entering the trade, we're going to be looking to get 50% of our max profit, and then we're out. Don't think you're going to be right, and try and squeeze it out a little bit more and try and get that full decay. At the end of the day, keep in mind, because the spread is going to be a little bit tight, it's not going to decay right away, that last bit. That after 50%, it could take a lot long. It could take another week or so to get that last 50%. And it's just not worth the risk, because remember, when we're setting this strategy up, you guys, we're playing the probabilities. And if you've beaten the probabilities, take your money off the table. If you were right away and you got that 50% of the max profit, pull out of it, because keep in mind the probabilities of being tested on that strike that you're short are still quite high. So if you've gotten the right move, you've gotten the volatility contraction, get out of it. Take your money off the table, move on to another strategy. All right, you've beaten the probabilities. Take advantage of that. Can you please send me the recording after this session? Yeah, everybody will be getting a recording after this session for sure. And if anybody has any problems with the screen freezing up, we're at capacity again, that just log off and hopefully you can log back in is the only thing I can say. Since we're at capacity, you might not be able to, but generally that's what we kind of recommend. All right. Rough figures, but often find that the curve is misleading because often 50% of the premium is gained in the first 20% of the time frame of several months. Stefan, you know, that's very true. And that curve is really, it's a generalized rule in a sense. So it's more of in theory. There's a lot of things that can affect that. So yes and no, I guess, is the only thing I can say about that. Luke's asking, what's gamma risk? Gamma risk means, you know, when we're selling this, gamma affects the second dollar move of delta in a sense. And the closer you get to expiration, gamma at those close to expiration or gamma closer to expiration increases, and those strikes that are closer to at the money in a sense, which we are very likely going to be, especially if it just moves sideways, will really start affecting your premiums rapidly. So I like to get away from that in this type of strategy. When we're setting it up 35 days to go and we've seen our premium decay, there's no sense in just messing around with any wild moves or anything like that. Exit approach when trade goes bad, acceptable loss. So with this one in particular, the way that I'm talking about, I'm going to also talk about ways to set it up in like an IRA and expand your risk parameters in a sense. Like people who have low risk tolerances maybe don't like selling strategies because of the quote unquote higher risk, which if you ask me, you know, I think that's debatable. I think selling premium is a lower risk strategy than buying options. But a lot of people like the fact that you know a lot of your potential loss when you're buying an option strategy. You know when you're paying a certain premium, that's all you can lose. This, we are going to have defined risk, so we know exactly what we're going to lose. So for me, I write it out. I can't remember, Luke. I write it out because it's defined risk, especially in the beginning, the way I'm going to set this up. We know what our risk parameters are. I know my probabilities also. So I know my probabilities of being tested on this are pretty high. So I'm going to kind of ride it out. And if it looks like it's going to be a full loser, then it's a full loser for me. But I'm going to play the probabilities. And sure, the probabilities are going to bite me every once in a while, but I know that my probabilities of success are, you know, 65% or more. And the way that I get out of this at 50% of max profit, I've increased that probability even more. So it's about an 80% probability of success by getting out early. Does that make sense? Does that make sense? If a trade goes awry, do you just take the max loss, or do you try to adjust the trade, defend the trade? If so, how? Great question. With this one, I don't defend it. As I mentioned, those reasons before. There's no real great way to manage this strategy because it is defined. It's going to be pretty tight, and buying another option around it is just going to increase your risk. So I just kind of leave it the way it is and let it ride out and play the probabilities. Do you ever roll out the spread? Yes, I will, Don. Absolutely. If I'm still sure that I guess that goes back to Luke's question. That would be a way that I do manage this risk, is roll out for a credit and for duration. Give myself more duration to be right. Increase the credit, lowers my overall max loss in a sense because you're collecting another credit. So I will roll it out in time, absolutely, especially if I am still under the assumption that this is going to rally. Okay? All right. So great point, Don. I do roll this out quite often actually if it's against me and I'm still under the same assumption. So let's go over this real quick. Max profit is going to be the short put that we got the credit for minus the long put, which is the debit. So the difference between those, or the premium that we receive at the inception of this, is our max profit. Our max loss is going to be the difference between the strike prices minus the credit we receive. So if it's a $5 wide spread, we're going to want to collect at a minimum of $1.25 and a maximum, or it's going to be somewhere between $1.25 and $1.50 is what we're looking. Hopefully $1.50 would be best case scenario on a $5 wide. But basically what I'm looking for my max profit is a third the width of the strike, 1/3 the width of the strike. So on a dollar wide, that's about 33 cents. The minimum I'm going to accept is 25 cents. Okay, the 33 cents is the best case scenario in a sense. And then the max loss is a dollar wide minus that 33 cents would be 67 cents. So yes, you are risking more. And the reason why you're risking more is because you have a high probability trade. So anytime you have high probabilities, you usually are going to have to risk a little bit more, okay? Which is kind of opposite in a sense of a credit. You know, when you pay a debit, I mean, when you pay a debit, you guys, you know, your risk is really high. You have a high probability in some regards, especially if you're buying the out the money, but your probabilities are still only about 50-50 that you're going to be right. So that's the trade-off. I mean, I would rather collect a little bit of credit and a small credit to have a high probability of success than a 50-50. I mean, you might as well flip a coin. Whereas when we're doing this one, we have much better probabilities of success. You're going to have better probabilities of success with this strategy than you would even going to, especially going to a casino, I guess. And the break even is going to be your short put strike minus the net credit. So it's short put strike. If we're short the 50 puts and we collected 33 cents, our break even is 49.67. All right. So it's the short put strike minus the net credit. All right, so this is usually at the part of the webinar, you guys, where I throw it out to you guys and we will go over this strategy around ones that you guys like to trade around, and we'll go through these different rules that I went over, those essentials to success, one by one, and look at high probability and high implied volatility. So we want something with high implied volatility percent. The way you figure that out is pretty easy. You have a numerator and a denominator in this equation. In the numerator, which is on top, you take where the IV is now, which is 0.24, subtract that by 6, and then that sum is divided by the high and the low sum. So that equation will give you what the IV percent is, and in something like Microsoft where it's not coming up with that IV percent over here, that's how you figure it out. Basically 24 minus 6, so you've got 18 divided by what is that, 24. 18 divided by 24, you can easily see that that is in a high implied volatility environment. So let me just pull up the calculator. We'll go over it one more time. So that 24 minus 6 is 18. So we basically take 18 and divide that by the high minus low, which the high, let's just round it off to 30, minus 6 is 24. So you divide that by 24 and we get, it's 75, it's at 75 IV percent. Okay, and that's important because anytime we sell strategies, we're above 50%, and this is above 50%, so that would fit that rule. Anything below 50% on an individual underlying, we're going to be looking at different strategies, and I have strategies for every type of environment around IV. And the other thing is, for say a ETF, ETFs are a basket. Anything that's a basket or an index or something like that, those are going to have lower implied volatility percents over the course of a full year. Yes, they will spike up in the 90s and 100s, but keep in mind, because it's a basket, that's going to have a relatively low ETF, or sorry, an ETF is going to have a relatively low IV percent, and that's pretty important. So if it's a basket of goods like an ETF, anything above a 30 is usually where I'm going to be going with the ETFs. It's got to be above 30 though. A couple of questions coming up real quick. Let's see this before we get into Amazon and a couple of other ones. Another service I read last night claims that credit spreads are terrible strategies, setting oneself up to blow account due to the volatility collapse risk. Well, Chuck, I don't know who the heck told you that, but that's absolutely incorrect. You know, if you're selling naked strategies, naked calls and stuff like that, yeah, you do have some risk, but you're not going to blow out account doing volatility collapse. Volatility collapsing is absolutely what we want, because volatility, when it comes out, really takes the premium out. You know, I'll show you some examples of low premium or low volatile underlyings where if you're in low volatility, you have to get really close to the market. And when volatility comes out, I can even show you that. I'll show you something real quick here. Let's look at a trade here just for volatility collapse. We can go like this and go theoretical price. Let's get out of this one. Right now we've got a 23 IV percent. This might not be the best one to do it, but basically if the underlying doesn't move, we can just look at this right here. The underlying doesn't move on the stock price. We're going to probably have to change the date just to get a little bit of couple of days. So a couple of days goes by. And volatility, let's say that volatility decreases by 50%. Okay, decreases by 50% of this 23, so it goes down to like 11. All right, so if we do that and hit enter, look what happens to these premiums. They just get decimated. Even the at the monies, I mean, it's going to go from $2 to 30 cents. So they just go way down. And that might be a little bit crazy on that end, but at the end of the day, even a 20% decrease in that number might give us, for some reason it's not wanting to give me very good results here, but basically the volatility, this is basically volatility going down and how it affects your premium. Let's just try it on today. Let's go reset. Reset. Oh, that's why, because the dates were so screwed up. I didn't reset the date. Sorry about that. So let's say it goes down by 50%. So that goes down to 11 and a half or something like that. Hit enter. So it still did the same thing. Why is it today's date? So let's try 20%. So you can see that they still get decimated even on a 20% decrease in that type of scenario. I don't know why that doesn't seem to be, I don't think that seems to be accurate just off the top of my head, but you can understand the volatility. That's a specific thing for volatility adjustment in this number, and if that goes down, premiums go down too. Trust me. That's all I can say, I guess, there. What would you say about using this strategy around earnings? IV is higher, but you want to have the expiration be a couple of weeks after the earnings for IV to come back down, maybe something like DGX. Dave, it's something like earnings, Microsoft actually, you can tell Microsoft has earnings in this cycle, so they're next week. I would sell this option. This is a better example. I don't know why that other one was being funny, but you can see the volatility, what it would do if volatility collapsed. And that is something I do. I go for the near expiration, sell the premium, and get that volatility collapse and collect that premium on earnings. So I'm in one day, out the next, Dave. And I've done a whole segment on earnings setup, and since we're in earnings season, those are good ones to watch, you guys, because I have specific rules around those that you guys can implement for earnings. Most stocks would have a high IV rank going into earnings. Would you say stay away from those stocks? Maybe I have it backwards on volatility risk. Confused. Thanks. Chuck, volatility does spike. As a matter of fact, it always is going to spike, and it's usually going to be closest to the high during those. And as we can see on a chart here, you can see after earnings, like this is an earnings, that's we used to call this volatility crush. And that's where all the premium comes out. And it's the beauty in volatility collapsing is you can be directionally wrong and still make money, which is another thing that with that volatility collapse that's not going to blow up in your face, is that when you're directionally wrong and you get volatility crush happening, you can still make money. You could have it really be, if you looked at that one thing here, you know, you could have sold these and gone into the money in a sense and still made money. So you will see that where you can come right to at the money, and with that volatility crush happening, you still made money. So that's the beauty in getting that volatility crush. And the beauty in earnings is knowing exactly when that is happening. That's, you know, anytime there's not an earnings event, then you don't necessarily know if you're selling high volatility at that point, because it could continue to go a little bit higher, as it shows up in this picture here. You know, you could have sold, this was high volatility, but then it got a little bit higher even yet. So that's the risk you're taking here. But around earnings, you know it's going to crush. It's just 99% of the time, and that's a ballpark figure off the top of my head, you will see volatility crushing and not increasing after the event, because what happens is all the information's out there. All right. Okay, so 70% probability is what a lot of people like. I often prefer an 85 to 90% probability. Reason income with that much less stress for folks, more interest in modest income rather than attempting to maximize profit. Stefan, I do that around naked strategies. I go out that far, but you won't really be able to collect much of a credit with this strategy if you are doing it with the risk parameters that I'm looking at here. So let's go into a couple of these that people were asking about. Luke likes Amazon. We're going to go big or go home. Sorry. All right, so we're going to skip that. We're going to look closer to expiration. Expiration, Amazon doesn't have their, because there's a break in the chart here. They probably have earnings coming up pretty soon, but I'm going to assume there's no earnings in all of these examples, you guys, because basically everything that's above 50 IV% here has earnings in it. Even though Deere says it doesn't and Target says it doesn't, they do have earnings closer to the end of this expiration cycle. So it will not fit with this rule, because with selling premium around earnings, I'm doing it right before that earnings event, like the day before. If it comes out in the afternoon, I'm doing it that day, and if it comes out the next morning, I'm doing it the day before. So I can get that high IV and knowing the collapse is going to happen right after I put on the strategy. With this, we would want it to be something where there isn't any earnings going on, like you know, something like Costco would be a good example. I think they have a high IV right now and no earnings coming in anytime soon. But as you can see, they have pretty high IV. It's starting to come off, but they don't have earnings in this next cycle. So, or right in here, I think their earnings fall somewhere out here. So this would be an example of, it's had a big sell-off. We could look to take advantage of it. It actually doesn't work out very well on the, I already looked at it for this particular webinar, so it didn't really work out very well. So let's look at Amazon, and assuming there's no earnings coming in, which I think they do have earnings coming up. we can look at it. So basically, we're going to start looking at the delta for the 36-ish delta, 35 delta, and it's $5 wide here, so we're going to look to sell this one. And so this is another thing, good example. So if you look at this, I said my rule of thumb here is move it 3 ticks to the left. That means the bid ask should be about $1 wide, which right here you can see they are right there inside of $1 for those. So that fits that rule. So we're going to sell that one, and we're going to buy the what did I sell? The 75. So we'll buy the 70s just to look for the example, and it a third the width of the strike. That fits that rule. So you know, we'd be looking to collect about $1.25 to $1.50 something. $1.55. This is $1.60, so that exceeds that. So what I would simply do then, since that met that rule and overdid that rule, I'd go down a little bit further and check the 70s to the 75s. I'm still getting that, so why not go further out? Sell the 60 until it doesn't work. $1.50, so that would be your pick 'em. I'd probably go with the 70s and buy the 65s and do that one. Get an extra 10 cents, and then I'd be covering this when I could buy it back for like 81 cents. That would be perfect for 50% the max profit, right? Does that make sense? So that fits in line with that rule. We got high IV percent, as you can see here, 68. That's what's allowing us to get so far away from it. If it had low IV, we would probably be up in here trying to do that, and we're really close to the market. So that's the beauty of getting high IV. We can get further away from the market, and puts usually even allow you to get further away than even that call spread that we talked about last week, selling those. Okay, AMD is something Ed was asking about. Advanced Micro Devices. Does it fit the rule? It's $13 stock, so it fits the rule. It's 2 cents wide, so that's pretty good. That means that there's good participation in there. We're going to be looking at the 35 delta, so we're going to be about $1 away. I don't look at this one very often, but if we're bullish on it, which I could easily see it just want to trade sideways here with the market profile being the way it is, so I wouldn't mind doing something like this. So let's look at selling the 81s, buying the 12s, 35 cents, so that fits the rule. We could even look at going a little bit wider. I might even just do that one and crank it up just a little bit, put it in at 26 cents, work myself down to 25 and just leave it. One thing about this, you guys, anytime you guys are putting on a strategy, it doesn't cost you guys any commissions to cancel replays, to enter this order, go back into your tab, cancel, replace the order, lower it. That is the best practice. Don't ever just go with what they tell you to do, especially if you're doing just naked strategies for the most part, because if you're just making the market a little bit better, when there's a lot of participation in there, somebody's just waiting in the weeds for you. And you might kind of generate a auto leg of a spread for somebody else and get hit right away. So start out rather high and work yourself down to where you're comfortable and stop. Don't ever go just necessarily to the mid-market on something like that, because it doesn't cost you anything to cancel replace, but if you get hit immediately, it probably costs you a penny, and that may not seem like a whole lot, but over the course of your trading career, those pennies will add up to a lot. So make sure you're diligent in that. You should have a couple of cancel replaces for every order you enter. When you said the strikes are $5 five away, is that 5 strikes or a delta 5? That's 5 on the Amazon one. It's $5 is what I'm talking about. On a $5 wide, we want to collect a third the width of the strikes, which is somewhere around $1, you know, $1.65, something like that, $1.60-ish. But the minimum I'm going to be willing to take is a quarter the width of the strike, which would be this, 25 cents on a dollar wide or $1.25 on a $5. Same thing for $2.50 one. That's what, off the top of my head, 70 some odd cents. Cap and one lot strikes again. Captain Rick's captain, self-proclaimed captain one lot. Love it. All right, so let's look at a couple other ones. Somebody else said NVIDIA. So let's delete this one. Look at it. Another thing to do is look at the charts. Like NVIDIA is above this. I'd look at your support resistance, whether it's you like to look at Fibonacci maybe or something like that. You can always add these things into that. If you're a follower of Primo, he does a lot of technical analysis as well. I would maybe look to try and get below a Fibonacci level, or I'm more of a market profile guy. I'd probably be looking at these as they're going to act as support there. So I would look for that as well. So as long as I could get below something like that, NVIDIA, we'd want to probably be below the 40s or something like that. If best case scenario, it's not going to happen. But $5 wide, start out with this 30 delta one. NVIDIA, it looks like it's about 20 cents wide here, but you can see the ones that are closer to at the money, 3 ticks to the left, 16 cents wide. They're close to 10, 15 cents, so that works for that rule as far as I'm concerned. I've traded a lot of this, so it's going to work out. So again, $1.65, that's inside that rule. We'll run this down for a cap in one lot. $1.65, that fits that rule. It fits the rule of the tight bid ask, 90% IV. That fits that rule. All of those things work together. Of course, the one thing is it's going to have earnings in there. So keep in mind, we're doing this with the assumption there's no earnings when we set this up. The only time we'd set up a spread like this with earnings is the day before or right before those earnings are released, because that's where you're going to get the highest volatility, bang for your buck. All right, so I wanted to go into look at this on the Analyze tab, and there you can see what your max risk is versus your max reward on this one. 300, basically $5 wide minus the $1.64, that gives you $3.46 or $3.46 or $346 is your max loss. Max profit is going to be that 164, but I'm going to be looking to get out of this at around 80 some cents, you guys, and it should happen within a week or two. So that's the beauty in trying to do it, and you don't have to ride out that last few days. Don't get in and out of these as fast as you can. All right, AXP. Another one somebody was asking about, American Express. So it's got low IV, so I'm pretty sure right now that it'll be a good example to show how you're going to have to get closer. So it's an $85 strike. I'm just going to look for a high IV one. We can compare it to we'll compare it to Microsoft. So the high IV versus this one, you can see there's no 36 to start. So we'd probably have to go, the problem with this is you usually have to go a little bit closer. So 84 cents, that fits that rule though, but note how close we are, 20 some cents away from being tested. And it's got about a 50% probability of being, or a 90 some odd, 94% probability of being tested. Because remember, it's 2 times that delta is the probability of being tested. And we're definitely not going to get it for if we go any further down. But compared to Microsoft, so we're 50 cents down to have to put that spread on, but Microsoft having that super high implied volatility being around the same type of situation, we are going to probably be able to get a little bit further away. I guess we're not going to be really. It's going to be just about as close because they're not giving us good ones. Let's see. So Target, let's look at one down here. I'm going to just try and compare something because Target being a $50 stock should be a little bit easier to compare that. So Target being 53, it's got an 89 IV. And go in here and look at this. So it's $5 wide. Oh, we're going to have to go very close to the market, but that's not going to give us our $1.25, 89 cents on a $2.50 wide. So $2.50 wide, 89 cents. That fits with the rule. That gives us about $1 to the downside, let's call it, just for averages, or for just a ballpark, I mean. And then go down here for something that's really close to that pricing. And the closest thing we're going to get is, let's go with BBBY. And with this, as you can see, we're going to have to be real close again for that same distance away, 47 handle, to get that 80 some cents. You can see we're 25 cents away here. The other one we were closer to $1, like wasn't quite $1. It was like 80 or 90 cents. But you can see that when implied volatility, the point I want to make is when implied volatility is really low, you have to get closer to the market. So that's why another reason why you want to implement this in a high implied volatility environment, because then probabilities are overstated, or sorry, volatility is overstated and should revert back towards the mean. And if you sold this in a low implied volatility market, not only are you closer to the money, you are also at risk of volatility expanding. So you could be directionally right. This market could go up, and if volatility expands dramatically on you, you're going to lose money because these premiums are going to get pumped up, and that's going to hurt you. So you really don't want that to happen. You don't want volatility to expand on you. You'd rather do it in a high implied volatility market, because then probabilities are it's going to revert back to the mean. Does that make sense for everybody? Okay, I got a couple of questions coming up real quick. Do you exit at 50% profits for all your trades or only selected strategy? Most of them, Luke, I get out. Most of my credit collection strategies, the ones where I'm selling them, I will get out for 50%. Something like an iron butterfly, then I'm looking at a little bit more closely to a 25%. And I go into all those rules in those webinars, but I don't really have it. But for the most part, especially this short call spread and the short put spread, I'm looking at 50% of my max profit on that. So we're looking to make 33 cents per dollar wide spread. Correct? Yes. 30, and I say 33%. The width of the strikes, because $1 wide would give you 33 cents. $2. That way you can expand it. Now, one thing I was mentioning earlier with, and that's where your starting point is for this, okay? Now, if you want to start looking at increasing your risk and stuff like that, your risk parameters, if you have a low risk tolerance and you're a newer trader and you're only used to buying strategies, this is a good one to get into to get used to selling credit spreads. Do it in high implied volatility environments. Now, if you're wanting to start increasing, like, hey, I'm getting this, I like it, I want to increase my probabilities even more. Well, in my eyes, to increase your probabilities of success even more is to sell naked calls or naked puts, for that matter. And yes, you do have a risk of loss if the market drops, but those are black swan events. They almost never happen, right? So at the end of the day, you want to go a little bit further out. So maybe I would increase the spread, if this fit the rules. So BBBY wasn't a good one. So Microsoft, let's say, getting us out there, I would start out selling the strategy the correct way and then increase that spread a little bit more. And now that doesn't fit the rule anymore because I've gone further out like that. but it's getting you used to it. And I would probably even go further, roll it down, and then widen it that way to make that kind of credit. And get used to that to expand it, because when you're selling naked strategies, you look for like the 16 delta. And that's the ultimate goal, because then you only have, when I say you've gone further away, increase your probability of success, because now you're at an 84% probability of a winning trade. Whereas this is, going to be closer to, well, this one in particular is going to be closer to a 47% probability of a winning trade. But when we're trying to set it up with that 35 delta, that's a 65% probability of success. And when you're out here further down the line, you only have a 30% probability of the market coming down and testing you even. So you don't have to sweat it out. Does that make sense for everybody? So the idea is to always increase your probabilities of success. If you go out here and just buy the stock, Microsoft, the probabilities of success with that is 50-50. Anytime you go out and buy a stock, it's 50-50. I mean, that's the probabilities are the probabilities. Yes, one could say, hey, market always goes up, so you always make money on stocks when they go up. Well, yes and no. They do correct, and they do go down in and of themselves. So the probability are the probabilities. So 50% probability, you flip a coin for the most part on being right at time of inception. With this probability of success, we're increasing it to 35% probability of success at inception. And then if you get out there to the naked, you got the strategy is 65% probability of success. And the naked strategy, way out here, you're increasing that to 84%. So always look to increase your probabilities of success. And if you set it up with the charts as well and find support and resistance, and you're a good chart person, then that increases those probabilities even more. So Dave, I'm long 3,000 shares of AMD. Which bull put strategy would you advise to generate monthly income? If you're already long AMD, then I would actually be looking to do covered call strategies, David. And, it comes down to whether or not you want to have those called away from you. If you're not willing to have that happen, maybe you bought them at a super low price. But covered calls is the best way to generate income around those, and you lower your overall prices paid for those particular AMD. Now, I wouldn't do it for all 3,000 of them, but I would be a call seller of those. And you'd be selling them like out at the 16 delta. So that means that's a hard problem to have when your 16 delta calls go into the money. That means it really outpaced the move. So it's only going to happen rare, and then you could buy those AMD back when you get a pullback. For instance, like this could have been that move when those got called away from you, and then you just buy them back when you see a dip down to like a support level. I mean, that's how I got into trading options. I mentioned that in college. I bought stock, and then I started selling calls against it. It was against IBM and Walmart, and I let those things get called away from me all the time, and then I just bought them back on the dip. It was like Walmart couldn't get above 50, and IBM really couldn't get above 100 back in the day. And I was always selling like the 55 calls in Walmart and like the 110 calls in IBM and letting them get called away from me and just waiting for it to dip back down. So if that were to happen, otherwise I just got to keep the premium. So if you wanted to add more to your AMD, then this would be a great strategy, because then you could, if you got put the stock, then you just got long it. And that's where you could be putting this on at levels that you wanted to purchase that stock. In that regard, I'd probably be just selling puts. at like a 16 delta if I wanted to take on more stock, but and hope that it got put to me. Right? So probabilities is what it's all about, you know, and always play the probabilities. I mean, at the end of the day, you guys, I'm sure, realize that you're better off if you trade with probabilities in your favor. I mean, look at what's happened to Vegas. They play with all the probabilities in their favor, and look how many light bulbs they're able to buy and replace. A lot. It's because they've realized this game. So you guys should really be trading with this kind of knowledge. And right now we're doing this how to trade like the Wolfman, $36. I mean, if you guys have learned anything at all about probabilities and think that that's going to help you out in your career, click on the link in the chat box. It's a direct link for this. I'll throw it in there right now for the link for this, just so it's a little bit easier than having to copy all this stuff down. The link's in that chat box I just put. We've been communicating in the questions box, but if you're watching this on tape delay, you can pause this and just type this into your URL. But like I said, if you've enjoyed my instructions, if you've learned anything at all, especially if you guys are one of my regulars, click on that link in that chat box there, because this deal's only good for you guys that have taken part in this webinar. All right. The best way to become a better trader and to be more consistent is to learn, which is, you know, I implore all of you guys to do whatever you can to learn more. And obviously you guys have taken that first step by taking this webinar. And what that does, it's going to make you see things more clearly and make those decisions more confidently, because, you know, you basically increase your knowledge. You know your risks, and that's the gray area when everybody else is teaching it. They're just teaching you how to set it up, which anybody can do, but they're not teaching you about those risks and how you can increase your probabilities and things of that nature. So, I mean, wouldn't you say that knowing how to create an option strategy around a technical analysis and things of that nature is going to build you as a person, I guess, and create more consistent winners? It's definitely what's going to happen, because you're going to play with those probabilities. And I show you how to set up the options screen. You heard Shady Tree and I going through and talking about setting up the market profile and how to trade that market profile. That's what I use. That's that blue stuff on the side. History of options, how to measure your winning trades, or when the trade is going for you and how to measure that. Time decay, protecting your portfolio with options, especially with the high interest rates. Interest rates increase, portfolios get decimated, you guys, with interest rates increasing, because you're not going to probably hold those bonds for 30 years, and the price of that bond is going to crater as interest rates increase. And I go into how much your bond portfolio is going to crater with these increased interest rates going forward. So at the end of the day, trading with probabilities will make you more mechanical, and it's the best way to get ahead in this game. I mean, like I said, anyone can teach you guys how to set up this strategy, but not how to increase your probabilities of success. And that's what I teach in all of my webinars. Every single webinar I go through how to increase those probabilities. And that's going to make you more mechanical at the end of the day. So, and that's in option selling strategies is the best way to create alpha in your portfolio. People will talk about creating alpha in a portfolio, and you can't really do it by just going out and buying stocks or buying ETFs like the SPY and things of that nature. That's just tracking the market. You got to create alpha by doing something other than that, and options is the best way to do that. So when you're trading with the right tools in the right situation, you're going to be more productive state of mind. You're going to put on more strategies, which, you know, creates more opportunities and ultimately builds your confidence. And don't get frustrated if the first time you put on a strategy the probabilities go against you. Just hold solace in knowing that the more you are in this for the long haul, those probabilities are going to come back in your favor. It's kind of like Vegas, you know. I mean, Vegas knows that if you beat them on the probabilities, they're going to buy you a hotel room or give you a hotel room to stay the night because they want those probabilities to switch back in their favor. They know the probabilities are in their favor. They know you've beaten them in the probabilities. They just want you to stay there longer. And that's the idea with this. Is you're the house. The longer you stay in this, the probabilities will come back to you in a sense. So if you learned anything at all today, you guys know you should be trading with this knowledge. So just, what do you say? Click on that link right there in the chat or in the chat window for this webinar or for this series of different webinars, this full-on course. I mean, there's a lot of stuff in there and even some fun stuff like the history of options, which is really cool. All right, guys. So that's about all I got for you guys. I see a couple other questions popping up, so I'll get to those here in a second, but if you can't take that, take it easy. And thanks, guys. I want to thank everybody for showing up. One other thing, this is also a link for it here, but future webinars, we're going to be drilling down on different options and trades when and where I find them appropriate. But if you ever want to reach out to us with any questions, contact us at 310-598-6677, or you can email us at trading@protraderstrategies.com. So like I said, if you're watching this on the tape delay, just kind of punch that into your URL because the link in the chat won't be there. All right, so take advantage of that. All right, thanks, JQ. Take it easy. The options, Ryan, man. Thanks, I appreciate that. Are your videos online or DVD form? They are online, Chuck. So and it's great because you can go in there and you can check them off as you watch them, so you know which ones you've seen. So that's really cool that way. Like there's going to be a little box by every one of the windows, so like you can skip around too. You don't have to do them right in order. And this is the most important, one of the most important ones right now, especially, not necessarily in general, but right now with the Fed talking about increasing interest rates. And if you have a portfolio, an IRA, or something like that, you have probably, 40, 50% of your portfolio in interest rate bearing products. And as those interest rates go up, the value of those go down because everybody's chasing higher yield, right? And you can't beat that cycle. You can't get out of your current bonds and buy higher yield and make money on it. It's going to take you like 7 years to make up that loss in the increase in interest rates. It's crazy. And the best way to do it is to really just start trading options around it. All right, thanks, Ted. Appreciate it. Thank you for the kind words. Oh, the room was full before you got in? I know. It was banging it out for a while there. Are your Cubbies worth a hoot this year, Rick asking? I don't think so. He just got a White Sox player too, and a lot of people are saying we kind of traded down for him. Gave up a lot of good guys to get some pitching going because our pitching is not looking too good. Chuck was asking, when do you get out of your earnings strategies? I get out the next day. It's in the morning. I put it on after 1 o'clock before the earnings, after 1 p.m. before the earnings day, so they might come out in the afternoon or the next morning, and then I get out immediately in the first 15 to 30 minutes. Cubs, the Orioles are the best team. That's debatable, Ted. All right, guys, have a great weekend. Take care. Oh, there's one other question I think I missed. Is there a good way to build a watch list for stocks that meet this criteria? The watch list that I have up there, I mean, the criteria I look at for for this, my watch list is all of these are going to have tight bid ask. I have Aon in here, but I just watch Aon. I don't actually trade Aon. I just kind of watch the stock. And I think Monsanto, I don't even know what's going on with Monsanto, but it has, there's a few in here that I bend on that rule that go a little outside of that bid ask width. But then I just put them in here and throw in the IV percent over here to the side, and TOS doesn't do it. I actually have code for that, but that I put in here, and look for the high IV or low IV depending on what kind of strategy I'm looking to implement. Are your earning strategies available in your videos? Yes, Don, you can. They are. So you can, like I said, you can call us at this number right here and get those, because yeah, those are worth the price of admission right now too. So especially in earnings season. And if you guys are members of my premium subscription, I'm going to be talking about all of those options earnings strategies in those videos, and when I set them up, how I set them up, and when I take them off. So check those out too. Yeah, I have a whole thing on it, like 4 or 5 different videos on just earnings strategies and how to set them up. So check it out. Show us the URL. Yeah, I can show that. It's in that chat window. JL, if you know the chat, we've been talking back and forth through the questions. There's a little chat thing. If you hit the down or hit the side arrow, it goes down. There's a little link, and you can just click on it. It's a little bit easier. Part of the go-to. This is a dead link, but it can be written down. It's also at the top of that. I don't know if you guys can see it. I can see it on mine, but right here at the top as well. Where is the premium subscription info? It is, you have to go on the Pro Trader Strategies website or email us and ask somebody about it. You can easily call too. There's guys there that are traders and can answer questions as well, but reach out to us here. I don't have a link for the premium subscription right now. Cool. All right, guys. Take care. Yes, and gals. Guys for me is neutral. Is either way, I guess. Guys and gals, take care. Hey, have a great weekend to you too, Sam, everybody.